Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for November 21st of 2022. Here, a disclaimer for important information. As we get into the holiday week and actually into the holiday season, there's a lot of data that people are going to be looking at. Obviously, retail sales is very important. Inflation, the pace of which declines, we're beginning to see some of that. Economic growth, we're beginning to see some degradation of growth and not some outright necessarily declines, but obviously some slowing growth, which we expected. And we'll start off this week with an update of the expected future path of short-term interest rates. And you can see that this curve kind of bubbles up around 5%, maybe 5.05%. as we get into June of next year. And this carries us all the way out to January of 2025. So this is essentially Fed funds futures. It's a market expectation for future short-term rates. And so where we sit here today, we're basically at 4%, a little bit shy of that. And so peak interest rates, which have bounced around a little bit. At one point, it was only 4.75. And just a few weeks ago, the terminal rate was about 5.25. Right now, it's 5.05. So just to be clear, that's the expected peak in short-term rates, after which the market is expecting those rates to go back down as the Fed begins to ease again. And so, when you see that path of interest rates moving from 378 to 5.05, that is that period of time that I've been talking about for quite some time of turbulence, where the market is trying to ascertain the future path of longer term interest rates, frankly, and the path of longer term inflation expectations, which we know are relatively anchored right now. But there's just a period of uncertainty as those short-term rates continue to rise that I think we're going to have a little bit of volatility and perhaps some turbulence, not only in the data, but also in our market. But as you can see right here, interest rates are expected to go down over time. We've been talking about a slowdown in the economy, and of course we've been talking about this path to this expected recession. Now, at this point, we still expect that recession to be mild, but we are consistently getting these reinforcing signals that we're on the cusp of that, and this is one of them. This is the percent of the yield curve right now that's in inversion, and right now that number is around 75%. And you can see here that in prior downturns and prior recessions, you can see that this is a very telling statistic. So again, it's not as strong necessarily as it was back in 1973-74 or back in the late 1970s before we hit the hyperinflation, if you will. But it's certainly above the 70% threshold, which has been a pretty strong indicator of future recession activity. We look at a lot of different indicators of tightening in our economy, and obviously from a monetary policy perspective, there are several things that central banks can do. They can raise interest rates, and they can reduce the money supply by impacting things such as demand here. And we see this is a composite, if you will, of all of the major central banks, the European Central Bank, Bank of Japan, Bank of England, as well as the Federal Reserve. And you can see balance sheets are going down quite a bit. So they're contracting their balance sheets, which means either they're letting securities run off that are maturing and not replacing those, or they're selling those outright into the market. And so when you sell fixed income instruments out into the market, as these central banks are doing, they're taking money in for the sale, and that money is being drawn out of the economy, and that is called tightening. And so you can clearly see here that that's what's going on out not just in the U.S. but across the globe right now. Now we talk about money supply as well, and this figure I think has more predictive power than anything else on future inflation levels. And you can see as you track the upper part of this chart, this is the global money supply excluding the U.S. So I want to focus for a minute just on the global situation, but the same picture can be painted for the U.S. But you can see a somewhat linear rise in money supply going back to 2004, and then you hit the pandemic, and that really accelerates. You can see that bump up and that cresting, and so that number is coming down. So global money supply, just as it is here in the U.S., is coming down at a fairly strong clip. And you can see the year-over-year change below, and you can see how dramatic that actually is right now. And so money supply growth slowing and actually going, in some cases, close to negative. You're contracting your economy. This is one of the best indicators that inflation's set to fall, because when you inject more liquidity, more dollars available to buy a fixed number of goods, that is a textbook definition of inflation. And when you withdraw that liquidity, then that takes the inflation pressures away. And so I think this is the telling statistic right here from a global perspective, that global inflation will be falling in the coming months and quarters ahead. Here's the leading economic indicator, diffusion index, and this is a pretty good indicator of recession. Again, just another one of these things that's kind of giving us feedback that, hey, yes, we're close to a recession. Again, just to paint that picture, we do believe that it is going to be a relatively mild recession. Don't anticipate a policy mistake. You can't rule it out, but right now we feel that these stars are aligning, and the expectations level has been fairly well set and priced into the markets. But in this chart, you can see the LEI, back in 2000, when it rolled over, it was a precursor of the recession that we had back then, and it gave off a fairly strong inflation signal, or excuse me, a recession signal. And every once in a while, it gives you false signals when it rolls over, but it has on a number of occasions, and it's definitely giving us one right now in the October reading. So obviously we'll continue to follow this. LEI is rolling over. Does it mean that it's guaranteeing a recession? Absolutely not, because about as often as it does predict inflation, it turns out to be a false signal. But it's worth noting and watching and monitoring. What we have here is a chart of excess savings. You can see this data series that goes back to the beginning of 2020, so just prior to the pandemic, as it's measured and kind of indexed to the pre-pandemic period. You can see the dramatic rise in savings due in many respects to the stimulus payments that people received. That was excess savings for a lot of people that wound up saving it. Lower income people wound up spending most of it. But you can see excess savings going materially higher, and towards the end of 2021, you could see that number kind of flattening out, and then now it's in the process of rolling over. And you see those savings being drawn down, particularly as a percent of 2023 income. And this is defined by observed savings minus savings level implied by pre-pandemic savings rate. That's that asterisk there, and it just implies that this is just being benchmarked to whatever that level was pre-pandemic. And you can see still high. This is still indicative of kind of the engine that's fueling consumer spending. But as we'll see here coming up in a few slides, we're also seeing credit card balances move higher as well. As we were talking about the stimulus payments and how at the lower income levels, you saw a lot of folks spend that money. At higher income levels, it was basically saved. It was treated as excess. But there were still savings at the lower end, and lowest income Americans. And again, some of this is driven by leverage. It's driven by some other things, but you can see the cash balances are being drawn down to help maintain a consistent level of consumption. Here's inventories at U.S. retailers. I thought this was interesting. we see excluding auto and parts dealers. I mean, these are just traditional retail inventories all through the chain, and those are levels are fairly high right now. It's not necessarily because of lack of demand, but we do know demand is, kind of flagging a bit. Obviously, we've seen in the last couple of charts that consumption remains relatively high. People are drawing down their savings. We know we'll see this coming up where they're putting more balances on their credit cards to maintain spending, but at the same time, you have the supply chain issues really kind of working themselves out. I mean, the supply chain, we've got some charts coming up on container rates just falling through the floor almost. And what that is doing is it's resulting in higher inventories, not necessarily of autos and parts dealers, as you see in that amber line, but in just about every other category, we're seeing higher inventory levels heading into the holiday shopping season, which is interesting because it may result in some measure of discounting, and we already see prices kind of rolling over. So when you think about, this totality of inflation, if you have high inventories that in this space of kind of like flat but not necessarily accelerating demand, you could have price discounting, which would be a very interesting dynamic based on this inflation backdrop we've been dealing with for several quarters now. Here is a chart of prices for apparel and footwear. This is a monthly change, so month over month, September to October, and this kind of dovetails to a little bit to some extent to that prior chart with the inventory levels, but you already see here on a month over month basis, you've got apparel categories, jewelry, watches, suits, boys, girls apparel, you just see all these categories rolling over. Price changes are negative, and in very few categories are you seeing them positive. But again, this is data that's tracked by the Labor Department, and it's about as real time as you can get. So question is this going to be persistent throughout the end of the year? Do these numbers abate somewhat? But this is clearly a disinflationary impulse. Here is retail and food service sales, basically change from the pandemic. So this is all indexed to, that February before the shutdown. And you can see online very strong. You see the online as a percent of the total as well, which is not a chart that I've included, but you can see that number consistently is moving higher as a percent of total sales. You can see restaurants, bars, department stores are having a bit of trouble right now, and that's where you could see inventory build up leading to price discounting, either before or after the holidays. But you see in a lot of other areas, you see retail and food service sales continuing to move higher. Again, this consumption story has not petered out yet. Now, here's a chart that I wanted to make sure that we touched on, because this is actually meaningful, even though we haven't seen a rash of delinquencies, and we've got a chart that follows this to talk about that. But you can see these balances are really moving higher from a year ago, and you can see, like, going back to 2008, the change in credit card balances. I mean, this is a percent year over year. And you can see back in 2008, we haven't seen the rate of gain that we're seeing right now, particularly amongst younger buyers, 18 to 29 years of age. That number's up 25%, 30 to 59, up 15%. And these are pretty dramatic levels that we should be paying attention to. Here is serious delinquencies. And I think what's notable here is that you are seeing an uptick in credit card delinquencies, which you're seeing auto loan, mortgages, not so much. These things, have been, from a historical perspective, extremely low relative to history, but they are moving up higher. The one big anomaly here is student loans. So, government student loans defaults by nature have kind of dropped to the floor because the government has issued a moratorium on payments, on repayments, and has extended that moratorium through the end of this year. So once that period of abatement ends and borrowers are then again expected to resume or commence payments on their student loans, you'd expect to see the student loan numbers begin to rise. And again, as you can see here, historically, relative to other categories, student loan delinquencies tend to be much higher. Here's labor data as we see, unemployment rate moving lower. And so this is from a Bank of America research investment committee that I spend a lot of time with every month. And their assertion, which is corroborated in several other pieces of research that I've read lately, is that the Fed is not going to slow down until they see some chinks in the labor market. And labor's been exceptionally strong. We know wages are high. We know hiring is still tight. Even though we've had some changes in the labor participation rate, there's still about 1.7 to 1.9 jobs for every unemployed worker out there. But what the Fed is clearly signaling in their speeches and their dialogue and in their rhetoric is that unemployment rather will need to move higher for them to get off this high horse of inflation. Of course, they have a dual mandate, which is stable prices, essentially, and stable employment, low employment, full employment. And, you could argue that that's the case here, but they're focusing so much on stable prices that I think the employment or labor component of their dual mandate has just been kind of chucked to the side. But I do agree that they'll want to see some erosion in the labor market consistent with the demand destruction that they hope to generate with higher interest rates. Here's payroll growth, and we have a Morgan Stanley report that is actually fairly consistent with other pieces of research I've read. That's on the left-hand side. And then you've got an expectation for the unemployment rate as we look ahead into 2023 and 2024. And so I think this is meaningful. I mean, to the point that we were making in that last slide, that I think the Fed's going to need to see some degradation in the labor market. I think that is expected. So it's not, for that to develop is not going to be a surprise. You can see here, and again, this chart on the left is very emblematic of other research that I have read and that I, frankly, in my own opinion, subscribe to, that you're going to see that labor market degradation. You're going to see the change in payrolls slow. And then at some point, again, 2023, about mid-year, you see that kind of plateau. Again, very consistent with this thought of 6 to 9 months, relatively speaking, of kind of choppiness here in the data and choppiness maybe in the market. But then middle of 2023, you begin to kind of look out on the horizon and see, that next cycle begin to emerge. And again, the labor market's not expected to kind of torpedo back by any stretch, but it's expected to begin resuming some positive growth, even if on the right-hand side here, you see that the unemployment rate ekes up. It's just that we've been at such a low and fairly unusually low unemployment rate for quite some time, that when you look out at a 4 to 4.5% unemployment rate, that is not inconsistent with the beginnings of new market cycles, and to have unemployment rate coming out of obviously if we felt like the recession that was pending, if you will, was going to be a hard one, then that unemployment rate would be much higher, closer to 10%. But at this point, all these signals tend to point to a shallow recession that does result in some decline in labor, some increase net on the unemployment rate, but then ultimately this resumption of job growth as we head into 2024. Here's the rise in housing supply, and it's an interesting overlay here because they drop in the blue, dark blue here, new housing supply as a number of months, and we've been talking a lot about housing and how that's been softening as of late with higher rates and demand dropping, and obviously the relocation factor really kind of going away, and the cash buyer really not being motivated right now. You see that housing supply is moving back up, and then they overlay this with the unemployment rate as kind of a leading, well, let me say the housing supply as a bit of a leading indicator. And when supply moves up, about 6 months later, you see the unemployment rate move higher. And so, again, this is not inconsistent with the last chart that we just looked at, where that unemployment rate is expected to move higher. This one, where the relationship, ironically, is fairly strong, it also suggests that unemployment rate is going to move higher. Weakest home buying conditions on record. That is probably not a surprise. We've had a cataclysm of different things. Obviously, prices. We had an asset bubble, if you will, when we had all of that liquidity and money supply growth post-pandemic. It was just begging house prices to move higher. Well, that's reversed. But housing prices are still high, and then, of course, interest rates moving higher pretty rapidly, resulting in higher borrowing rates, mortgage rates for borrowers, is resulting in a really tight situation in home buying right now. 30-year fixed mortgage rates. This is interesting because, yes, mortgage rates have really spiked. You can see that clearly here. In fact, at 7.08. We saw literally just a couple weeks ago, and that was the highest level that we have seen since 2002. However, we saw that move down from 7.08 to 6.61, and that is a dramatic change in essentially 1 week. And it's as strong a change, as virulent a change in 1 week that we have seen in many years. Here's single-family building permits. You can see that those are quite negative now and have been moving down for a little while now. And I think they're going to end 2022 on a fairly low note. Again, not a surprise. Housing has softened up. Months of inventory is moving higher. So naturally, you'd expect building permits and the desire to build, as these prices are moving down on the part of builders and builder sentiment kind of flagging, you'd expect to see this kind of a data point right now. So you see here, we've got building permits overall on the upper side of this chart. And then you see building permits rolling over, and you see the Mortgage Bankers Association, or MBA Purchase Index, falling lower as well. And those are definitely correlated, and for obvious reasons. Obviously, if you have an index of purchasing that's moving lower, then the desire to build and your building permits are going to fall too. And what this is suggesting here is that maybe that's got a little bit farther to fall. Don't disagree with that at all. On the lower part of this, you've got the National Association of Home Builders Index. This is the Home Builders Index that I referred to in that last slide. Again, that's rolling over. Again, with prices moving lower, home builders are less enthusiastic about getting product out on the market. And so you see here that sentiment is fairly strong, and that's likely to continue this downward sloping trend in housing starts for the foreseeable future. So you can see here that there is something interesting in housing starts. Now, we've talked for a few minutes now about single family, and you can see that clearly in this chart right here. That's definitely rolling over. And it's important because, it represents the bulk of starts, but obviously you have other categories. You have 2 to 4 units. Those are kind of like duplexes, right? And then you've got 5 or more units, and those are multifamily, like apartments. And you could see that the starts for multifamily continue to pick up and continue to move in a fairly linear fashion upwards. At the same time, the single family is rolling over in a pretty big way. We've got a little bit of data here. We've got from the Philly Fed, their monthly indicator, and then we've got one data point that I wanted to show from Kansas City Fed. Just, overall, when you look at manufacturing and non-manufacturing, the data is very similar when you go from Philly to Kansas City. The data is very similar here. And so I'm not going to repeat kind of these trends on the Kansas City data, but I will show you Philly Fed data here. And you can see new orders down and negative. No surprise. We know things are slowing down. Manufacturing index itself actually was a lot lower than expected. So manufacturing is slowing down, even though it has been pretty strong lately. It is clearly slowing down. Again, same thing in Kansas City Fed data. Here's number of employees. You see that rolling over. It's not necessarily negative yet, but expected average employee work week on the right-hand side is definitely negative. Again, this is very consistent across these Fed districts overall. So, you see hiring intentions. That's a key takeaway here. Hiring intentions are rolling over right now. Expected prices paid and prices received from the manufacturing side. Both of those rolling over in a pretty meaningful way. Here's the Kansas City Fed data that I wanted to show you. It's new orders for exports, and this is something that has been kind of manifesting for a while, but we've had such a strong dollar this year. When you think about it, when your dollar is strong, that makes your export to other countries very expensive because they're looking at your currency and it's increasing in value. It makes it more expensive for them to buy your stuff. And so that naturally has had taken its toll on new orders, new export orders here. So here's a supply chain index and the container freight rates. And you can see here very clearly, and we kind of alluded to this before when we were talking about retail sales and inventories going up, that, it's all really tied back to here. So you see the supply chain pressures, with this chart on the left here, that data point moving up over the zero line indicates that the supply chain is really eased up. You can see, just literally a year ago, that was at a real peak pinch point. Here it shows as a trough, but the data with the chart on the left is telling you is that, whereas last year supply chain issues were extremely tight and challenging, now they're relatively easy. And then you can see on the right hand side prices for a container freight, basically a shipping container. The cost of that has gone down dramatically. In fact, this is the dollar cost of that. If you look at it from a percentage year-over-year standpoint, that's down like 80%. We get into some equity stuff now. This is from Uri and Timmer at Fidelity. Interesting. I've seen some analogs, which basically are comparing the current trend in the S&P 500 with prior trends. In this case, he's comparing it and doing this overlay with the 1946 to 1949 time frame. And I've also seen an analog that draws a parallel to 2008. Now, to be fair, I didn't show the 2008. It does show, more legs down in the market, and I'm not saying that can't happen. I think this analog makes a lot more sense in terms of where we're going. That so much has been priced into the market. There's a lot of expectations. For us to have like a 2008 environment, we would have to have a complete blowout in expectations, like something we would have to start getting data that absolutely nobody could have fathomed, and it has to be very much negative. And again, I think there's trend lines that are being developed that are kind of well assumed at this point that things are going to slow down and employment's going to pick up, so on and so forth. So I feel like this 1946 to 1949 analog makes a lot more sense. And so what is this telling us really? So basically it's saying, listen, I think we've got more choppiness to go. Maybe we've got another leg down, but then we find a bottom and then we just meander for a while. And we saw this to some degree in the 70s where, it was kind of like maybe a stagflation environment or slow growth environment after this recession, that I don't think that we have this like barn burner new cycle emerge. But we do have a cycle emerge. It's just not that strong because it's going to take a while for inflation to get back down to 2%. And so, this kind of like purplish line represents what happened towards the latter half of that 1946 to 1949 timeframe. And it just meanders. And again, obviously, and then it picks up after that. But I think that's a lot of what we should expect. So this is consistent with this financial planning, theory that, future expected returns over the next few years are just not going to be that exciting. Well, looking at areas of the market that are being rewarded, expense discipline, capital strength, dividend capability, meaning companies that can pay dividends. These are all the areas of the market in a difficult market that are being rewarded, and particularly operational efficiency. Again, if you think about that, it's intuitive because these are the companies that manage their expenses, that leaves them with more cash flow and more cash to buy back their stock, to make capital investments and things like that. And you would think that those are the companies that are going to be rewarded, and that's absolutely the case right now. Here is a quick chart of the non-profitable technology companies. And as we saw, when we had that lower than expected CPI number a week before last, we have had a dramatic turnaround, like literally like a 25% change in these kind of like, poor performing companies in 1 week, which is really a rare and kind of unique experience. You see here going back to 2015, obviously we've seen a lot more amplitude, a lot more volatility in these names, and that's clearly an evidence in that amber diffusion chart down below. But just I highlight this because the last chart that I had talked about how companies with strong balance sheets that had good fiscal discipline were being rewarded in valuations. But here I'm showing you that the ones that aren't profitable just had like almost a blowout record week on the upside. It just goes to show you that volatility is still with us and likely with us for a while. Here's an interesting chart that I think just kind of puts this year in a nutshell. You've got in the blue, you've got Meta, which is Facebook, and then in the kind of the darker blue there, you've got Exxon. And this is their market cap. And they've gone completely the opposite direction, a time where in a recessionary environment or pre-recessionary environment where you have high inflation and energy costs, you can see the value of Exxon has consistently moved higher. At the same time, you've seen how the whack-a-mole approach to technology has really bludgeoned these technology stocks. Now, to be clear, there's more specific things going on with these companies, but in many respects, you could insert just about any energy company and any long duration technology company in this chart, and you'd have very similar results. A little bit of perspective on portfolio management. We've talked about this a lot. This is kind of the performance of the traditional 60-40 portfolio, 60% equity, 40% fixed income through the first 3 quarters of the year. So this is taking that first 9 months data for each of these years and then putting them on this chart. And so, as we've talked about ad nauseum, this has been a terrible year, excuse me, for diversification because it hasn't worked. Fixed income at various points in this year has been down more than the equity market. And even gold has been down. So these diversified portfolios have really taken it on the chin this year. But as you can see here, it's very much an anomaly. And you can see that there's a much greater preponderance of observations where that portfolio is positive. And we've shown you this in dot plots. We've shown you in trend lines. We've shown you in other ways, like consistently over the last several months, how bad a year the 60 portfolio has had. But this is just one other way of kind of highlighting to you how odd, unusual, and not normal this is to have this year. And usually when you have a negative year, you can see along here, looking at those negative observations, that rarely do you have a second consecutive year of negative performance out of a 60-40 portfolio, but oftentimes the next year results in a pretty strong positive return for that portfolio. So a quick look at equity ETF money flows, and whereas we've seen kind of really negative sentiment on equities and equity ETFs earlier this year, with the CPI announcement, we've seen a rather dramatic change in that. So we have seen greater fund flows over the last couple of weeks. And what it's doing is it's recognizing the valuation differentials. You can see here, this is a valuation slide. And so it represents, that line represents the median 12-month forward price to earnings ratio. So it's a forward-looking valuation metric that you can see here is extremely low right now. That forward PE ratio is for equity ETFs is pretty low, down close to around 12. And you can see that that's almost 2 standard deviations below the norm, which in kind of a statistical sense gets us into rarefied air, meaning that the valuations are pretty low. And so it's not too surprising to see equity money flows be positive here over the last couple of weeks. I thought I'd show this. This is from BCA. We see capital spending outlooks vary depending on who you look at. So the next 2 charts, I think, will highlight the fact that depending on who you survey, which groups you look at, which parts of the economy you examine, it is possible to get differing viewpoints. So in this chart, there's a clear rolling over of capital spending intentions. And so BCA is making the argument here that when you have capital spending that rolls over, that your manufacturing output is going to roll over. And I almost think that these are concurrent measures. They're coincident indicators, meaning that one doesn't necessarily depend on the other, but they both happen at the same time due to the same factors. And so from a manufacturing standpoint, I don't disagree with this at all. I think, clearly that there is capital spending that is, people are holding money a little bit closer to the vest right now, particularly on the manufacturing side. Why would they want to ratchet up output when inventories are high and we're on the prospect of some demand destruction created by higher interest rates? Now, here's a survey of S&P 500 companies in the third quarter. And so you can see year over year dividend intentions or spending intentions are up. You see buybacks are down. But then in this chart, you see, at least from an S&P 500 perspective, that capital spending is looking quite a bit higher. So, again, it goes to the theory that if you look at different parts of the economy, you're going to get maybe some different data. But clearly here, S&P 500 companies are wanting to spend on new capital projects. Here's a chart that I'm going to end on, research spending and growth. We see R&D expenditures as a share of GDP move materially higher over the last couple of years. Obviously, there's things like AI and advanced broadband technologies that are commanding a lot of these dollars. But what's interesting here is that you see total factor productivity on a 10-year average lagging that now. So, from a kind of a common sense standpoint, what you should be getting in return for your investments in research and development is an increase in productivity. And so at various times when R&D spending goes up, you actually do see that. You just don't see it right now, which is interesting. And for all of the rapid increase in R&D spending, over time, there is a pretty decent relationship. So I would expect this productivity number to kind of catch up over time to R&D, because companies are flush with cash on their balance sheet. they've managed well since the global financial crisis, and so there is money to spend on research and development. And if this chart does turn and it does result in increased productivity, that is an anchor for inflation. That helps to bring inflation down when you increase your productivity. And so if this is true and this productivity begins to catch up with R&D spending, that's another very strong disinflationary impulse into the market. We got for today. Hope you have a wonderful week. Take care, and we'll talk to you again soon.